It's no secret the price levels in the US are currently rising at a much faster rate than ever seen before. This upward change in consumer prices is inherently dangerous for our wallets, as we all know inflation leads to great consequences for cash savings. However, there's no need to panic as we have people like Warren Buffett, a famous investor whose net worth goes up to billions of dollars, coming up with great ideas when it comes to investing strategies. This year, he advises investors to own stocks that are sure to help us alleviate such consequences and ultimately save more money to successfully build our wealth. Hey, welcome to Stock Market Mate. Today we'll talk about the top stocks to own during inflation, according to Warren Buffett. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Warren Buffett is famous for being one of the most successful investors out there. As of April 19, 2022, his net worth has listed at $125 billion. Many investors around the globe follow the investing philosophy of Buffett. When Warren Buffett evaluates a stock level of excellence in relation to its price, he asks himself a few questions, such as, is the company performing well? Does it have a hefty amount of debt? How are its profit margins? And a few other questions to assess and analyze stocks. Moreover, in a letter once addressed to shareholders in 1987, he highlights the importance of two characteristics that investors should look for when trying to combat inflation. The first one was the power to increase prices easily, and second, the ability to take on more business without having to spend a lot of money. But why is inflation particularly a big concern for most investors? Well, in general, inflation is an increase in prices, which causes people to lose their purchasing power. For investors, a positive return can turn into a negative one if inflation gets worse. So with a sharp rise of prices lately, let's go over and revisit Buffett's suggestions for combating inflation, which he once referred to as a gigantic corporate tapeworm. We'll be going through a list of stocks, more specifically Berkshire Holdings, that Warren Buffett has confirmed to be a great way to combat inflation as they boast the characteristics mentioned as well as some strategies he suggested could undoubtedly get rid of the corporate tapeworm that is inflation. Number 4. Chevron or CVX. First on the list is Chevron, ticker symbol CVX. Loading up on Chevron is currently one of the biggest moves of Buffett this year. Chevron Corporation is an American multinational energy corporation and one of the successor companies of Standard Oil. Berkshire, according to SEC filings, currently holds $25.9 billion in the energy giant as of March 31st, a massive increase from the $4.5 billion it owned at the end of 2021. Moreover, Chevron is currently the third largest public holding at Berkshire Holdings, and it's not hard to see why this is so, as although the oil business is capital intensive, during periods of inflation it's known for doing very well. The price of oil has risen 45% year to date, making it the most heavily traded commodity globally. It is possible that this trend will continue due to the supply shock caused by Russia's invasion of Ukraine. Producers largely benefit from strong oil prices. Lately, Chevron's quarterly earnings increased 4 times over the past few years. This year, the stock is up almost 40%. Chevron pays dividend to shareholders quarterly with $1.42 per share. Its annual dividend yield is 3.4%. Number 3. Coca-Cola or KO. Next, we have the Coca-Cola Company, ticker symbol KO. The Coca-Cola Company is a US-based multinational beverage corporation, best known as the producer of Coca-Cola or Coke. Coca-Cola is a classic example of a business that survives a recession. A can of Coke is affordable for the vast majority of citizens regardless of economic conditions. Due to its strong market position, massive scale, and portfolio of iconic brands including Sprite, Fresca, Dasani, and Smartwater, the company enjoys cost advantages. Furthermore, the company sells its products in more than 200 countries and territories around the world, and it's clear that it can thrive despite tough times. After all, the company went public more than 100 years ago. Ever since the late 80s, Buffett has owned and held Coca-Cola in his portfolio. Moreover, Berkshire owns 400 million shares of the company today. They're worth roughly $25.8 billion. Coca-Cola shares have a dividend yield of 2.7% at current prices. Number 2. Apple or AAPL. Next on the list, we have the Apple Company with its ticker symbol AAPL. Apple Incorporated, as we all know, is an American multinational technology company that specializes in consumer electronics, software, and online services. People who spend $1,600 for a fancy high-tech phone would not call it a steal, as consumers love to splurge on Apple products, whether it be a laptop, phone, a smartwatch, or a handy iPad. Last year, management announced that over 1.65 billion active devices, including more than 1 billion iPhones, were installed. Although many competitors offer cheaper prices, the majority of the people still choose to buy Apple products. This means that whenever inflation spikes, Apple can pass on higher costs to its global consumer base without being too concerned about sales volume dropping. Currently, Apple is one of Buffett's largest publicly traded holdings, accounting for 40% of Berkshire's portfolio based on market value. In part, that concentration is due to Apple's stock price increase. Moreover, Apple currently has a dividend yield of 0.6%. Number 1. American Express, or AXP. The last one is American Express, and its ticker symbol is AXP. American Express Company is an American multinational corporation specialized in payment card services. AXP actually raised the annual fee on its Platinum card last year from $550 to $695, which proved its pricing power. Moreover, the company stands to benefit directly in an inflationary environment. Most of the company's revenue comes from discount prices, which are charged to merchants along with every Amex purchase. The company gets to take a cut of larger bills as the price of goods as well as services increase. There's definitely a lot to be optimistic about AXP as business is sure to be booming. In the first quarter, the company's revenue jumped 29% year over year to $11.7 billion. It is currently the fifth largest holding at Berkshire Hathaway, with 151.6 million shares. Moreover, Berkshire's stake is valued at almost $24 billion. It also owns shares of Visa and MasterCard, two of the competitors of American Express. However, the positions are minor in comparison. Currently, American Express shares over a dividend yield of 1.3%. And those are four of Warren Buffett's most valuable stocks when it comes to inflations. These companies are sure to help investors sail through the storms of inflation without having their portfolios jeopardized, according to Warren Buffett. Moreover, here are some of the strategies he suggested in order to beat inflation this year. Number 1. Invest in good businesses with low capital needs. According to Buffett, one of the keys to success is owning businesses that earn high returns on capital invested. Businesses with low capital needs and the ability to maintain profits should prosper during inflationary times than those whose position is maintained by investing more money at ever-increasing prices. Number 2. Look for companies that can raise prices during periods of higher inflation. In 2010, Buffett told the Financial Crisis Inquiry Commission that pricing power was the most important factor in evaluating a company. Furthermore, your business is profitable, you can raise prices without losing business to a competitor, and you have a very good reputation, he added. Number 5. Steer clear of traditional bonds. In his letter to Berkshire shareholders, Buffett wrote, "Bonds are not the right investment these days. Interest rates are still near historically low levels, so an inflationary environment might hurt bond investors tremendously. A 10-year bond yielding 2% is comparable to buying a business for 50 times their earnings, except that the earnings don't grow. Businesses that can raise their prices during periods of high inflation have a huge advantage, since they can offset their own increasing costs." Well, that concludes today's video. While the current inflation spike may last a while, it is difficult to predict whether or not it will decrease. When you're concerned about rising inflation, consider taking Buffett's advice and investing in productive assets such as high-quality businesses with lower capital needs, as well as staying away from low-yield bonds that don't increase their payments as inflation rises. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!